You're listening to the Infinite Banking Mastery Podcast. Did you know that you could build a tax-free pool of wealth that's liquid and accessible all your life while building your retirement nest egg? Gain full control of your financial future and stop relying on the government and banks. The wealthy have already discovered this wealth-building secret. Now it's your turn to get financially secure without following the conventional wisdom that keeps you in debt to banks. Now here's your host, Valerie LaRocque.
Hello and welcome back to Infinite Banking Mastery. I love teaching the mechanics of IBC, but there is something uniquely powerful about going back to the source. Back to the man who started all of this, Nelson Nash. I've mentioned his name a lot in many past podcast episodes, and I've also mentioned many times the book he wrote, Becoming Your Own Banker. As I've mentioned before, this book is the foundational book of the infinite banking concept. Nelson spent decades of his life teaching this philosophy all over the country until he passed away in 2019 at the age of 88. Nelson was not a typical financial guy. He was a forester by training, a student of Austrian economics by passion, and a man of deep faith and conviction. And the way he thought about money and about banking, about time, about human behavior was unlike anyone I'd ever encountered in this industry. So today, I want to walk you through some of his most powerful quotes. I'm going to read them, but also unpack what he meant. Because Nelson had a way of saying things that sound simple on the surface, but the more you sit with them, the more they reveal. If you've heard a little about IBC but haven't read this book yet, this episode is for you. And if you have read it, I think you'll hear some of these quotes differently today. Okay, the first quote. You finance everything you buy. You either pay interest to someone else or you give up interest you could have earned otherwise. This is probably Nelson's most famous line, and I've mentioned before many times, my favorite quote. It's the first major principle in becoming your own banker. He called it the very first thing you have to understand. And I think once you really get it, you can never look at money the same way again. What he meant was that most of us were taught that there are two ways to buy something. You either borrow money and pay interest to a bank, or you save up and pay cash. And if you pay cash, we think, great, no interest, I win. But Nelson said, not so fast. When you spend cash on something, you lose the future growth that money could have earned. That's a real cost. It's just invisible because it's an opportunity cost rather than a line item on a statement. Opportunity cost is the cost of what you missed out on because of your purchase. So in this case, if you pay cash for a new car, you will miss out on the growth that money could have earned you. So the question isn't whether you finance. The question is who captures the financing cost. Right now, for most people, it's the bank. IBC is about recapturing that cost for yourself. When you borrow against your policy and pay yourself back with interest, you're keeping the money flowing through your own system instead of someone else's. It completely reframes how you look at every purchase you make. Some party in your life is going to be the banker, whether you recognize it or not. That party should be you. Nelson isn't saying here that you might want to be your own banker. He's saying someone is going to play that role, and the only question is, who? Think about it. Every time you take out a car loan, a mortgage, a business line of credit, someone is sitting on the other side of that transaction, collecting interest, building their balance sheet, growing their wealth, using your payments. That party is the bank. Nelson's insight was that the banking function, the act of pooling capital, lending it out, and collecting interest, isn't something only institutions can do. It's a process. And a dividend-paying whole life insurance policy gives you the infrastructure to run that process yourself. You become the entity that holds the capital. You become the entity that lends it out to yourself, to your business, or to your children. And you become the entity that collects the interest and replenishes the pool. That's what it means to be your own banker. The banking function is happening in your life whether you're conscious of it or not. Nelson just wanted you to be the one in control of it. Quote number 3, it's not about interest rates or rates of return. It's about controlling the banking function. If I had $1 for every time someone asked me, but what's the rate of the return on an IBC policy? I'd have a very well-funded policy. And Nelson anticipated this question because he knew that's how most of us are wired. We've been taught to evaluate every financial decision through the lens of rate of return. Which account has the highest interest rate? Which investment has the best historical return? But Nelson said that way of thinking misses the point entirely. IBC is not an investment vehicle competing with the stock market. It is a banking system. And when you evaluate a bank, you don't ask what rate of return the bank earns. You look at the control, the access, the stability, and the function it provides. Your whole life policy's cash value grows at a guaranteed, consistent rate, with dividends on top of that. It's not going to make you rich overnight, but it provides a foundation of guaranteed, accessible, uninterrupted capital that no market account can match. The value isn't in the number on the statement. The value is in what the system allows you to do. Finance your life on your own terms, without permission from a bank, without market risk, without interruption. Nelson wants you to stop comparing IBC to investments and start thinking of it as infrastructure, because that's exactly what it is. Quote number 4, think long range. Simple 3 words, and yet this might be the most countercultural thing Nelson ever said. We live in a world built around instant gratification. We want returns and we want them now. We want results now. We want apps that tell us our net worth in real time. And when someone sits down and I show them an IBC illustration, the first thing they often look at is year 1, then year 2. When does this break even? Nelson's background as a forester shaped this philosophy deeply. He spent his early career planting trees. And when you plant trees, you don't look at the seedling and say, wow, this is disappointing. You understand that the value is in the system over time, that what you plant today creates shade and lumber and legacy decades from now. He used to tell a story about his own policies from the 1960s. By the end of his life, those policies were paying out more in annual dividends than he had paid in premiums. The system had grown so large that it was essentially paying for itself and then some. You can read more about this story if you'd like in his book, The Case for IBC. And that doesn't happen in year 1. It doesn't happen in year 5. It happens because someone made a decision to think long range, to be patient, and to trust the process. Nelson believed that one of the great diseases of modern financial thinking is short-term focus. IBC is the antidote. You are building something that will serve you for the rest of your life, and potentially your children's lives too. And that requires a different mindset than chasing quarterly returns. I just happened to read in an article today about the viewpoint of Warren Buffett when it comes to investing. I read this on the Wealth Advisor site, and it said, Berkshire Hathaway became one of history's greatest investment success stories, not by predicting short-term market moves, but by buying durable businesses, holding them for decades, and allowing compounding to do most of the work. Sounds like a similar philosophy to Nelson Nash, allowing time and compounding to build wealth, and of course, in Nelson's case, your actions as an honest banker as well. Quote number 5, don't steal the peas. This is a very popular quote in the IBC practitioner community. Nash used this phrase to describe what happens when you take policy loans and never pay them back, or pay them back so slowly that the loan balance grows and eats into the policy's cash value and performance. The analogy came from his analogy of a grocery store owner and how if you owned a grocery store, you wouldn't want to steal a can of peas from yourself or walk out the back door without paying for your groceries, because each can of peas that is paid for provides the resources to buy more peas. And if you're stealing from yourself, well, likely your employees are too. You want your business to grow in a healthy way and be profitable. In IBC terms, when you take a loan from your policy, that's the whole point. The system is designed to be used, but you have to pay it back with interest on a disciplined schedule, because the policy loan repayment is what replenishes your banking system and keeps it growing. Nelson said, if you can't afford to pay back a conventional loan from a bank, you probably can't afford to take a policy loan either. The discipline required is the same. The difference is that when you pay back a bank loan, the interest goes to them. When you pay back a policy loan, the benefit flows back to your system. Don't steal the peas. Use the system the way it was designed, with intention, discipline, and a commitment to replenishing what you borrow. Quote number 6, the policy owner's behavior is more critical than the behavior of the insurance company. People spend a lot of time evaluating insurance carriers, and insurance carriers matter in the sense that you want a mutual company with a good dividend history, a strong dividend history. You want financial stability. Of course, that's true, but Nelson was emphatic. The carrier is not the variable that determines whether IBC works for you. You are. A perfectly designed policy from the most reputable carrier in the country will underperform if the policy owner doesn't fund it consistently, doesn't repay loans with discipline, doesn't think long range, and doesn't commit to treating this like a real banking system. Conversely, a well-behaved policy owner who consistently funds their policy, repays loans promptly, and stays the course over decades will build something remarkable, regardless of whether their dividend rate fluctuates over time. Nash was essentially telling us, stop looking for the perfect external conditions and start looking at your own habits and behaviors, because your financial outcomes are a reflection of how you show up, not just what products you hold. And that's a hard truth. And it's also incredibly empowering because it means the outcome is largely in your hands. Quote number 7, your medium of exchange must be warehouse somewhere. There are no exceptions. Nelson said this in the context of explaining why IBC makes sense as a place to hold your capital, but the insight behind it is profound. Every dollar you have is sitting somewhere right now. It's in a checking account, a savings account, a 401k, a brokerage account, under your mattress. It's somewhere. The question is never whether your money is warehoused. The question is where and under what conditions. A checking account earns almost nothing. A savings account offers a little more. A 401k grows tax-deferred but is locked up and subject to market risk and controlled by IRS rules. The stock market can grow significantly, but also can shrink significantly. No guarantees. Whole life cash value, by contrast, is guaranteed to grow. It's accessible without penalty at any age. It's protected from creditors in most states. It grows tax-deferred and can be accessed income tax-free. And it doesn't fluctuate based on what happens in the market on any given Tuesday. Nelson wasn't saying whole life is the only place to warehouse money. He was saying be intentional about where you park your capital, because that decision has consequences. And for the portion of your wealth that needs to be stable, accessible, and growing, whole life insurance cash value is uniquely suited to that role. Nelson Nash passed away in March of 2019. But the philosophy he spent decades building and teaching is more alive than ever, because the problem he was solving hasn't gone away. People are still handing their banking function over to institutions that don't have their best interests at heart. They're still financing everything they buy and letting someone else capture the value. They're still making financial decisions based on short-term thinking and emotion. And what Nelson gave us, what this book and this concept represent, is a way out of that system. A way to reclaim control, not overnight and not without discipline, but steadily over time in a way that compounds and grows and eventually creates something remarkable. So if today's episode sparked something for you, I really encourage you to get the book, Becoming Your Own Banker, and read it. It's a quick read, about 90 pages, although you might want to read it more than once. Each time you come back to it, you'll find something new. Even I do. And if you want to talk about what an IBC policy could look like for you specifically, for your life, for your income and your goals, and you would like to work together, I would love to have a conversation with you. You can reach out to me at valerie@alphaomegawealth.com. Be sure to share this episode with someone who's been curious about IBC but doesn't know where to start. Sometimes all it takes is hearing the right words at the right moment. Until next time, think long range. Take care of yourself.
This is thepodcastfactory.com.